Welcome to the CEO of Destiny podcast, where you will find the tools to fulfill the purpose of your generation and wildly succeed in the marketplace. And now your host, Andre J. Benjamin.
Welcome to the CEO of Destiny podcast. I'm your host, Andre J. Benjamin, and I'm excited today to have a guest, an author, an investor, the chief investment officer at Tradecraft Capital. It's a lot of C's, at a crypto asset hedge fund. Jake holds a degree in computer science with a specialty in artificial intelligence. He graduated from the University of Texas at Austin and has his early work cited in over 700 Google Scholar Citations. He went on to become a software entrepreneur and an investor in traditional markets, building a multi-million-dollar software services firm and continuing as a successful angel investor before focusing on the crypto asset investment. I'm delighted to have the author of a new book that I've been really enjoying and actually having great conversations with our 11-year-old on, Mr. Jake Ryan. Jake, welcome to the show. How are you?
Great to be here. Thanks for that, Andre.
Yes. So first off, why don't you tell us a little about yourself? I know we always can read the bios and the information that you have listed, but tell us a little about yourself personally.
Sure. I went to school to get a computer science degree. I got out of school and was a software engineer for 15, 20 years. So we would build custom application development and build specialized business software for the likes of American Express or Fox Sports or just many companies that you've probably heard of. I started at MCI Communications, which was a global telecom company, but it went under. It was a Fortune 100 company. But then I started my own consulting firm in 2002 and did that for quite some time. About 2014, I started to do angel investing, and I started to kind of connect with some accelerators and VC firms out in LA. And I think I made about 15 investments. Many of those are still live today. I started to invest in blockchain companies. I think in 2015, I invested in 2 or 3. I started to invest in Bitcoin specifically in 2016. I think I paid maybe $468 for my first 3 coins. And then I thought, this really is at the intersection of economics, investment, and technology. And I know a pretty good amount of all of those things. And so I decided to start a hedge fund. And so I started a hedge fund in 2017 and 18 and brought a partner in and we've grown it from there. I think the last thing is probably 3 or 4 years ago, I really wanted to write a book. I had written 2 book proposals and they both didn't make it. They both died on the vine. None of them got a literary agent, but this long article I had written on Medium. It was called Crypto's Role in the Age of Autonomy. I thought it had legs, and I wrote that in 2018. So I really beefed it up and wrote a business proposal around it and got an agent, and the agent got 2 book deals for me, one from Wiley and one from another, and I took Wiley. And so that was kind of the story of how the book was born.
Perfect. We like to unpack things, and I want to definitely hear you elaborate on some of this. So, for instance, when you talk about you decided to start a hedge fund after making some investments in 2015. What sparked you? I mean, how did you even know about hedge funds? Explain what a hedge fund is for people that may not know what that is.
Sure. So, a hedge fund is a pooled investment. So I would be investing on behalf of other people. It has an exception to certain regulations with the SEC, and it's to get those exceptions, you only can accept high net worth individuals' money. So usually family offices or institutions or high net worth individuals that have $2 million and up. So that's, if you get those type of investors, you can go with less regulation. It's much less than something like a mutual fund. And you're able to invest in anything you want, basically. The goal is to maximize risk-adjusted returns. So sometimes you're hedging out certain risk, but you may be investing in an alternative asset. Could be exploration or some new whatever. And so hedge funds a lot of times will be formed, for alternative assets.
So where were you first exposed to hedge funds? Because you went from computer science to, kind of exploring, and I know you bought a couple of Bitcoins, but what got you to
Yeah, I had always wanted to be a hedge fund manager, really. I had grown up
as a child.
Yeah, as a kid. I think 14 or 15, I had bought my first mutual fund. It was a Fidelity Technology Select Fund. And then I bought my first couple of stocks at 16. One of them was Qualcomm, and that ended up doing really well and paid for a lot of my college. So I had been investing for a long time.
How did you get started?
My dad helped me.
Nice.
He was, my stepdad helped me just look in the paper and, kind of watch the prices and then, see how you might pick a particular stock or a particular mutual fund. And so I just found that fascinating.
And so you developed the habit as a young child, and then you kept on with it. You stuck with it.
That's it. Then after college, I, started doing regular public equities trading. And then I started to do options trading. And that's really where you get some of the skill that you need to be able to manage risk. And so
you wrote an article on Medium that really gained some steam. You talked about the previous book proposals that had failed because you were trying to score a literary agent to work with them. Can you elaborate on why particular you even wrote the article, and how it ended up, and why you were wanting to write a book? What was it that you're trying to express, and who's the target audience that you're aiming for? Like, who are you speaking to? Because I know when people write, you write with someone in mind. Sometimes it's themselves at a specific phase of life so that they can educate themselves.
Yeah, for me, I was at a particular phase in my life where self-expression was really important. I wanted to get, my voice out. And so I tried to sing, but I wasn't very good. I wasn't bad, but, I took singing lessons. But I really was a good writer. There was I could express myself in a way that people thought was interesting. I would do it in story form, and the goal is really to be storytelling. You don't want to read a reference manual, so you really want to read a story. So a lot of the book is more storytelling. I wanted to be a writer, so I knew it would take a long time. It's very hard to get a book published. They look for a lot of things, but I just kept at it over the years. And when crypto came around, when Bitcoin came around, I knew it was going to be transformational. I had gone through the internet. I was a software engineer during the internet bubble. And, I remember all the dot-coms, and I remember what it felt like in college to have this vision of what the internet could be. And, we could have these mobile phones, and we could, pipe a movie over the internet, but it was terrible back then. I mean, I worked as a customer service agent at an ISP, and, we'd do this dial up with modems, and people out in the hill country would call up and say, yeah, I just bought the internet and, it doesn't work. So you're standing there in the 90s with the reality of something that doesn't work very well, but with this vision, you could see what it could be in a decade or so. And so I had that same human experience about Bitcoin. And so I know this will be transformational for money, because I know the problems that we're having with our money.
So one of the things I really enjoy about your book is just the premises that you unpack in very basic language. Sometimes you read a book and people are up in the clouds in, ideologue land, like they're going back and forth with, I don't know who they're talking to, but I love the fact of how you unpack it and you just assume that the reader, and maybe it's because of what you said, because you're giving a narrative and you're putting a story around it. Maybe that's what it is being a great storyteller. But for me to be able to sit with my 11-year-old son, who's always like, okay, dad, what, and when I come to say, hey, what are you reading? And then he usually regrets asking me what I'm reading, right? Because it'll just glaze over. But when I showed him some of the things, because they ask a ton of questions, as you can imagine, especially once children start earning their own money from things that they do, because we don't do allowance. My wife and I don't do that because we would rather them, there's household management of common chores that are things that we all do. It's just part of living in a household. And then there are, if you want to do extra things, like, hey, mom, can I wax your car? Can I, clean your car out, vacuum it out, and then negotiate upon a price. We want them to develop that mindset rather than, getting a job and being paid. So anyway, with that being said, as they start to earn their own money and they go on Amazon, and Amazon sure gets a lot of their money because they've already scoped out some new Lego set or toys and whatnot, they start asking a ton of questions about money and what it does and what it is. And so I enjoy how you unpack that. Can you, one of the things that you really hit on is an overarching theme of the generational differences in understanding of economics and finance. Can you break that down a little bit? Can you speak to that?
Yeah, I mean, I would first start with what is money a bit, and
Yes, let's go there.
Really, it's from Adam Smith and from the beginning of economics, money is just the idea of being able to store value for a later date, right? And it has to also serve a function, right? If we were still in the barter system, we would have a problem. It's called the double coincidence of wants, which means if I have 2 cows and I want 2 chickens, without money, I would have to go find somebody who has chickens and wants cows.
It's the same thing.
You're really screwed. I mean, it takes forever for that to happen. So there needs to be something in the middle that has value and that can be a unit of account that just happens through the free market and determines a price. It can't be given down a price or value. That's where fiat currency and where unsound money principles really come from. The value has to be set in the free market. And so first, we really need money to create an economy and to be able to transact. And when we can transact more, we can start to continuously improve. And that happens through scalability. Once you become more specialized in certain tasks, you can make more for that, and more people get specialized and they get better and better in that. And so things can become cheaper, people can make more money, and the economy will grow. And so money really is at the base of that possibility. And that's really the function of money. Anything else is taking away from really the function of money.
So the storage of value and a medium of exchange that provides almost a buffer between, and it mitigates the double coincidence of wants, that people want the same thing at the same time, and they have to find a person with the exact same wants at this and with the exact same item to exchange, and it's a mess. The bartering system in that means is a mess. So it's to store value, because it's interesting that it's not almost how we treat money currently, which we'll get into.
It's a store of value, a medium of exchange, and then a unit of account, so that the free market determines how many cows you can buy with X currency, and so that is based on a free market. So yeah, those 3 things really are the function of money.
So that's interesting. So then now unpack a little bit about some of the terminologies that are used around us consistently, and just the generational difference in the understanding of those. And you unlock several of those because when we say boomers, we're speaking of baby boomers. There's a great book by, I think it's Neil Strauss, Generations, that really kind of outlines different cycles of the generations and kind of the different priorities and values of each generation and kind of where things could be headed based upon the studies that they did. But can you speak about baby boomers, and we'll talk a little bit about the greatest generation, and then I'm Generation X, I suppose, and my wife is Y. So
yeah, well, so there's a couple things. One thing that we have to really understand is that many of us, let's say in Generation X, learned about money from the baby boomers. And when the baby boomers learned about money, we had sound money. Okay, we had sound money then. So the idea of saving and the construct of business and what a loan was, that all meant something completely different than what it means now. So after 1971, when we went off the gold standard, we ended up with fiat currency, which is unsound money. And when you get unsound money or credit money, definitions change, right? For one thing, with commodity money, money is an asset. It's a commodity. Has value. When you go to fiat currency, you're going to a credit system, and so a dollar bill is actually a liability. It's a note, an IOU from a bank, and so everything gets ultimately settled at the Fed, right? Because they give credit to commercial banks give credit, and how you create
Federal Reserve. When you say the Federal Reserve,
yeah, the Federal Reserve.
Keep going.
So literally how you create money is through loans. So when you get loans, a car loan or a house loan or any type of loan like that, money is getting created. And what happens when those get paid back or get defaulted, money contracts. And so those can be those deflationary events. And so money just operates very differently when it's sound money versus when it's unsound money. And so
when you say sound money, can you speak to that? What is sound money versus unsound?
Sound money is commodity money that a price has been determined by the free market. So we've used seashells before. We've used, primarily metals and primarily gold for, millennia. It's ultimately kind of come down to gold and silver. And there's a few reasons for that. But it's really that there's a commodity. I mean, something of value, and the value has been set in the free market. There really also needs to be a cost of production. Like, it can't be free to create new money. Like, if it's free, then it's going to cause problems. So that's sound money, commodity money. The other type of money, credit money or fiat currency, is unsound money. There is no cost of production. A central bank issues it and manages it, and it ultimately is a political entity. And unfortunately, if it's political, at some point, any human is going to try to get something for nothing. When that happens, and it's happened
not in America,
over and over and over. It's happened, at least 7 times, 8 times in the last 2,000 years. We've done this many times, thinking that we can get something for nothing, and then that ends up leading to disaster.
So if we unpack that, a conversation. So someone who's a boomer, which would be my parents. My parents are boomers, and I honor them and respect them. My dad, I was caregiving for him, passed away in the last year. They did the best they had with the information they were given. So it's interesting to see the legitimate concerns around, if I talk about some of the things that we're even talking about on this podcast, if I talk about investing in something like cryptocurrency or blockchain, or even other things they may not know about, they say, oh, that's risky, or, you need to put it in the bank. go to a, all these kind of traditional means of a mutual fund, or if you're just put it in your Roth IRA or a 401k. Like, all of these things are information that they were, I saw them both work 30, 40 years in one place and then retire. And so they even would tell us the difference of, if you're someplace for 3 years, they think that you're flighty, because why are you moving around so much? You need to stay there and kind of plant your roots and climb up the ladder. And things have changed. So I love can you throw out a couple of things that we see differently in the generational conversations that are being held?
Sure. So one concept that's pretty interesting, Buckminster Fuller, Bucky Fuller, he's known for a lot of quotes, good quotes, and he's known for the geodesic dome. He was an inventor. He came out with this idea around the turn of the century called the knowledge doubling curve. And he said it would take about in 1900, it would take about 100 years for the world's knowledge or data to double. And then in 1945, it would take something like 35 years for knowledge to double. And then in 1980, it would take something like 10 years for knowledge to double. And then in 2000, it would take something like a year or two for knowledge to double. And he projected, and IBM went ahead with this concept because it kept being right, that by 2020, knowledge or data would double every 13 hours, right? And so things are changing at an exponential rate. And so the ability to learn and unlearn things is the most important thing now. You need to be able to learn and unlearn things. Sometimes you hear, strong conviction loosely held, or something like that. It's to be able to understand concepts and then be able to know when they're no longer valid. So that's been an issue with boomers. It's also they weren't digital native, right? They didn't grow up with computers. I started programming when I was 9. I was born in the 70s. I'm a Gen X. And so, it's just different with millennials. They came out with the internet. They never
Absolutely.
knew.
My wife remembers the internet her whole life, even though it wasn't as strong as it is. It definitely was there.
Yeah. So it's just different for a millennial to get Bitcoin. It's about one step. It makes total sense to them. Whereas Bitcoin to a boomer, it looks like magic internet money. It's fake, right? And so it's just kind of perspective from when you've grown up. Right now, savings is about the riskiest. It's one of the riskiest things you can do right now.
And I love let's go there when we talk about. That's what I was going to ask you, because I know you have a part about risky being the safe is more risky than anything. But can you, one author, I think it was Robert Kiyosaki, said he believes savings for suckers. What do you think of that statement? And can you, as you even alluded to how risky saving is, can you explain why saving, when we say that in a traditional sense of parking your money in the bank where it's safe and sound and it's going to hold value for you and you'll be able to give it to your grandkids because you built up. And I know people who are very sincere people, young people. There's young people who I know that have worked and saved of a pretty sizable, in today's terms, nest egg, over $200,000, and they don't invest in anything. They just put it in the bank because they have the premise of what we're talking about, of the concept of what they believe is sound money.
Well, if you get out of bed, you're taking risk.
Absolutely.
If you stay in bed, you are still taking a risk.
True.
Right? People don't think about that second one all the time, right? And so what's happening is, what we want to do is maintain our purchasing power, right? We want our money to at least maintain purchasing power. Or we may take one a little more risk and we want our money to make money. If you have it in a savings account, it's earning nothing or 1 basis point. while inflation as of April is at 4.2%. So you are losing 4.1% every year. That's not a good idea. So that's why it's one of the most risky things is you're guaranteed a loss in purchasing power if you just save money in a bank.
So my children my dad used to make me watch a show called Andy Griffith. And now that, my children want to watch some of the things that I watched as a kid. So we watch it and they're really fascinated with this show, which is weird to me that they're like, let's watch Andy Griffith. I'm like, really? So because they want to know how things were in that time. And so they ask questions about when they say something's expensive back then. It's only, let's say they said he paid 50, he saved up $3,000. And then there's just like this massive amount of money, or the things that people were able to get, houses and different things. And then the late 50s or early 60s. And our kids are saying, well, how is it that now houses are, $400,000 for just a little, small lot? So, and I try to tell them it's not the value of the item that has went up. It is the value of the money that has went down, has diminished. So
right.
it's a interesting. So I love that analogy of getting in bed versus staying in bed, and the deflation and how people are losing when they think that somehow it's going to bounce back. And I don't know. I think it really is a mental blockade, or just a kind of like a bias or a veil on the mind to not even be able to see that. You realize every time you go back to the bank and you look at this money, it's not the same value. Even when it's sitting there, it's not, it's lost. So the numbers may say the same, but the actual value of it is less. You can get less and less.
Right, and that continues, and that really depends on inflation. And so we're about to go through probably a secular, a long period of inflation. It's the only way. The Federal Reserve really has two choices. They could default, or they could try to pay the bill. And to try to pay the bill, they're going to have to print trillions of dollars to pay back the 30 trillion they owe now, plus another 100 trillion in unfunded liabilities.
So when you throw these numbers out, these are not the numbers that we hear through the media or the politicians, or as I call it, the lying pen of the scholar. Can you elaborate a little bit on kind of the real things that are owed versus what is told to us?
Sure.
We say 2 to 3 trillion or something small, and seems that it's repayable because people think about, well, we'll always earn so much and our nation is always productive. But can you speak to the entitlement programs and the different areas where liabilities have been created?
Well, okay, so there's a bunch of problems. One is the United States military is unauditable. So there has been a period, this is back in the 2000s, where 2.3 trillion is just unaccounted for, right? They cannot account for that. There's no way to audit the US military. They're going to try to do it in the next 10 years, but it's never been done. And we don't have a balanced budget, right? Ever.
It's never balanced.
We take in, let's call it $3 trillion or $3.3 trillion, something like that. And we spend, $4, $5, $6 trillion. So every year we're losing, I think we lost about $1 trillion in 2020, and the CBO, the Congressional Budget Office, said 2020 was the last. After 2020, the annual deficit will never be under $1 trillion. So that means it's going to be more than $1 trillion every year after 2020. If you go to usdebtclock.org, it's a great place to see how much we currently owe.
We used to watch it and it just became morbid. It's like
it's unbelievable. And so there's one other aspect to this, which is an unfunded liability. This means we have made promises to people in Social Security and Medicare, yet we don't have a pool of money to back up that promise. It is just something we're going to have to pay as we go. And through demographics,
people believe that it's sitting in the cloud waiting for them. It's waiting.
They do have some money. I'm not saying they don't have money in the Social Security fund or in Medicare. They have some,
but not enough.
But not enough. And so they're good, you know, to handle baby boomers. And after that, because of demographics, because of how big the boomer population was and having that many people age versus how many people are going to be working. When Social Security was created, there were 3 workers for every retired person. That isn't going to be the same when the boomers are starting, like right now. And so there's just, I think they've estimated 100 to 120 billion of unfunded liabilities. And so we just have a big, a totally unmanageable amount of money that we're going to owe. And so the Federal Reserve has 2 choices. They can monetize that debt. And what that means is continue to keep interest rates lower than inflation, which basically burns off the purchasing power of money. And so they're going to do that for 10, 15, 20 years, and then effectively be able to pay off the debt.
So how long do you see before we start talking about investment classes and a little more about blockchain, because you alluded early on to how you got exposed to it and even your first interactions with it. And what I loved about the book, I shared this before we started recording, is that I always want to have a very sound conversation with people because of the generational differences, because I know that there are people that watch the show and that listen to the podcast that are not familiar with some of these concepts. I don't want to just act like something is a magic pill or it's a cure-all to everything that we're facing. So that's what I enjoyed about your book, is that you lay out and you just say, this is what's going on. These are the problems. Here are some of the proposed solutions. What are you going to do? Here, you know, the information's laid before you. So can you speak a little bit to some of the things that people can do in their personal economics, how they're carrying themselves, how they would even select investments, the importance of evaluating investment classes, and why investing, just like you said, is getting out of bed. It's actually, getting into the game, getting into the show, rather than hoping that things are just going to pan out based upon what you earn from a job or what you earn even from people who have small businesses, but they've really just made it somewhat of it's just another job, and they don't take their money and make the money work for them. Can you explain kind of the importance of that and these principles of investing, and why you noticed the difference? Because you talked about going to school and you talked about working. So talk about how, you started investing and buying, and a stock worked out well for you. Talk about how you started to see that, and how people can see that difference versus just working a job and not and just putting it in the bank. I hope that makes sense.
I think one thing that's important is to know about long wave economic cycles, really. And so those short wave economic cycles are driven by credit, but the long wave economic cycles are always driven by technological revolution. It's happened 5 times in the last 200 years. It happened when we were in the industrial age. It happened with railroads. It happened when we electrified the cities and all the grids. It happened with oil and automobiles. And it happened with the internet and the age of communications. I think we've begun a new long wave economic cycle. And I think we've seen evidence of it over the last decade with artificial intelligence, the Internet of Things, or sensors, and robotics. Companies have gone about delivering on automation. They're just trying to automate everything. And that's been powerful, but it hasn't been transformational. It hasn't transformed how businesses are going to function. The last piece of that puzzle really is cryptocurrency, because it allows us to store, process, and transfer value, economic value, without human intervention. And so as these four technologies converge.
So peer-to-peer, when you say that, you're speaking of peer-to-peer versus having a third party, why if all money is quote unquote digital in the first place currently, why does the bank only have certain operating hours, and why does it take multiple days, and why are you charged fees to go across seas or whatnot? It's only after 6 p.m. you can't do a transaction. It doesn't make any sense currently.
And with blockchain, we're going to be able to have programmatic money. We're going to be able to, create bots and create these programs that say, if something happens, then send, this Bitcoin or this Ethereum here or there. If something happens, if interest rates change, then move money from here to there, all autonomously. It can make decisions in the field in real time, and then be able to move money. That's transformational. If you can converge AI, IoT, robotics, and money and cryptocurrency, those four things together you can create autonomous operations. Now, why is that powerful? Because the world is built on competition, and autonomy is the ultimate competitive advantage. It's the cheap, it's 24/7, it works for you. You don't have to feed it. It's going to be the most competitive approach to business. So we're going to see more and more autonomous agents. And so what I advocate is, consider these long wave economic cycles. What are these about? And investing in those. That's where I would be investing.
So when you speak on blockchain, define what a blockchain is. What are the blocks?
Right. The blockchains solve a couple problems, but they're good for like one or two or a few use cases. They really can't be applied to a bunch of problem sets because they're slow and they're expensive, and they only do a couple things really well. But what they do allow peer-to-peer transactions, because blockchains are immutable. That is, they cannot be, a record that is put into a block cannot be changed. What happens is blocks are built upon blocks, and so everything in the past can be determined, and seen, and can't be changed because of future blocks. Every continued block just guarantees the viability and the accuracy of past blocks. So that immutability is very important. It also allows consensus without a trusted third party. So it allows us to do peer-to-peer transactions. That's never been done. I mean, right now, all economic transactions are ultimately settled by a third party, by a bank that then goes to a commercial bank that then goes to a central bank. So there's always a third party to settle a transaction. So to be able to do it peer-to-peer eliminates friction in the form of time and money and expense. And so a great application of blockchain is to be money and to be able to transact money.
Mark Cuban said that people should put 1% of their net worth towards crypto class. If they don't, they could miss out. What do you think of this statement? He said like a minimum of 1%. What do you think about that?
Yeah, I would say 5%. Yeah, at least 5%. And then for every book you read, you can go up 5%.
Makes sense. Because you're saying the learning curve.
Yeah, you really need to be educated about this. One of the most important factors in investing is conviction, right? You need to be right, and you need to have the conviction. Conviction is so important because when things get rough, what are you going to do? And so,
You talk about the different, even what they call even the fourth industrial revolution, of almost like the digitization of our society, and the IoT and all these things. How do people evaluate and go? Because you talk about investing in long cycles, but what were some of the things that you begin to educate yourself on? How are we, speak to a couple of things that you found. It could be blogs, it could be research. I mean, maybe you'll email it later. Some things that you thought were useful to yourself. I know that there are a host of books that I read, yet I think it's good for people to lay out resources and kind of point out what they think on things.
yeah. So, I mean, I'm happy to give some resources that I have used, and maybe we can also put them in the show notes. But I've used, for books, I found, Crypto Assets by Bernesky, really great. I thought The Age of Cryptocurrency by Vigna was great.
That's a good one.
I loved The Bitcoin Standard by Saif Amos. And then really powerful is Technological Revolutions and Financial Capital by Carlota Perez. She's the one that outlines this whole long wave economic cycle thing. So there are also a lot of podcasts that I listen to. Tim Ferriss had a podcast called The Quiet Master of Cryptocurrency that was great. And then Laura Shin has a podcast called Unconfirmed, and she has another one called Unchained. And one of them is called The Basics, and that was really great. And then Laura Shin had one called Blockchain and Cryptocurrency, and I thought that was really great. So those are a few. And then just reading things like Cointelegraph or Reddit on Bitcoin is really good. There are a lot of articles that are really good. You're just going to have to get in Medium and get on some of the newsletters to get them. I really like Delphi Digital. They have a subscription, annual subscription. They have really good research, and you can get in there for an individual for pretty cheap. So all of them are great resources.
Thank you. What do you think about tokenizing assets? And some of the conferences I went to, the listeners know my journey. I started exposing myself about 2017, just off some conversations that I was having in the world I was in, and people started encouraging me to look into blockchain and cryptocurrency, and they started talking about tokenizing assets, and such as real estate. Say a skyscraper, and people could buy a piece of that skyscraper rather than traditional deals where only people with certain net worth can get into purchasing a skyscraper. So what do you think of things like that?
Yeah, I mean, I think those are good. The impact of tokenization is probably more linear. I mean, it'll be a little bit cheaper, and it provides two things. It provides you the ability to do diversification, because you can buy smaller units and then spread around your risk. And it creates liquidity where you might not be able to have it. So most real estate is pretty illiquid, because like a skyscraper, if you had to buy the whole thing, not many people can buy the whole thing. And so if it's smaller units, then, and they can sell, there's an exchange for that, then you're making an illiquid asset much more liquid. So there's a lot of advantages to that. But it's still the value of the building that really is ultimately what that's worth. So that, the asset class of the investment doesn't change per se on that. I think tokenization is important and valuable, but I think there's explosive growth in the crypto assets themselves. So
speak to that. Speak to about the crypto assets and talk about a few different investment classes.
Okay. I think that there's a few things. Like in the 1990s, we had these internet protocols that came out. HTTP, that's the one that allowed us to send web pages across. SMTP, that's the one that let us send emails across. And the protocols were free. And then what happened was people would build applications on top of them, and that's where they made money. But what if you could have invested in those internet protocols? You know, what if you could have invested in HTTP back then, and every time somebody sends a web page, you'd get fractions of a penny or whatever. That wasn't possible back then because they gave the protocols away. But that is possible now because the cryptocurrencies are a part of the blockchains, and those blockchains are the protocols and platforms that we're building the digital decentralized financial system on. We're building an entirely new financial system, peer-to-peer, decentralized, autonomous, to be able to be built on these platforms and protocols. And so investing in the protocols can allow you, you know, similar or analogous to being able to invest in protocols in the 90s like that. So
you made some, thank you for that. You made a statement in the book about how, and you even said it earlier on in this conversation about how someone from an older generation would look at Bitcoin. And these are some of the conversations I hear with people as they say, I don't know about that. And, you know, there's so many, of course, that we've got the mainstream machine pumping a lot of fear, uncertainty, and doubt and anxiety and everything. And every story is, you know, money laundering, drugs, you know, trafficking of people and all these things associated with it. And the question I personally ask, and I think to myself is, so these things weren't happening with what we call fiat, you know, and I'm not excusing them or saying that it shouldn't, but when people look at blockchain, they say it's risky. They say about you laid it out as talking about the immaculate kind of birth of crypto or Bitcoin in particular. And, you know, Bitcoin kind of is, when people don't know blockchain, people don't know Ethereum or, you know, the host of others. They might hear about the dog coin, the Doge coin, and the meme kind of stuff with Elon Musk. They hear about more of the eccentric things on the fringes, but they don't hear about, when they think Bitcoin, they think of that is the all-encompassing of it all. And there's a lot of people that are skeptical because, and people even say that to me, they said, you know, someone gave me an opportunity to put a little money in, you know, and I had a few, you know, let's say I had $10,000 and I was thinking about doing it. But then when I started to read up on it, it just seems creepy that, you know, nobody knows where this came from. What do you say? Can you speak to people's concerns about how it seems creepy that you can't, not necessarily tie it to a group, because I understand why that would be important to maintain the you know, the autonomy of it, but the people's skepticism around it, that it just they believe it seems somewhat creepy.
yeah, I think that Bitcoin is a little different because it doesn't have a head person, right? There's nobody, there's no one person like a Mark Cuban or anybody who could change it. Nobody owns it or is the figurehead.
So even Satoshi coming out of the smoke, if Satoshi was a real person, couldn't
know who the you know, it's a pseudonym. We don't know specifically who that they or him or she is. And that's valuable because, you know, there was nobody, you know, there was nobody to go after, nobody to blame, and nobody to change it, right? So it allowed this Bitcoin protocol to be able to grow organically in the free market. And so it was built with incentives for miners, for investors, for users, and people started to see that it had the 6 characteristics of what sound money would have, and
what are those 6 characteristics?
And do them better. So characteristics like divisibility, durability, scarcity, acceptability. I don't remember a couple
you spoke to the fact that they're having to be labor, which is important, work associated with it. So the miners.
Yeah, there's a cost of production that's critically important. And so Bitcoin satisfies all these, where fiat currency doesn't, because it's not scarce, right? There has to be a scarce component to it. There are only 21 billion Bitcoin. There will never be more than 21 million Bitcoin. And so that scarcity is valuable if it continues to be more and more acceptable. But I think we've hit the mark where we've hit the tipping point already, right? I think the risk is much less than it was 3 years ago. Right now, we had hit the number of crypto accounts or wallets hit about 17% of the market, of the total global market, which was similar to how many email accounts existed in 1997. And so I think we've hit a good tipping point of this thing being more and more acceptable. And so having those 6 characteristics of sound money really allows it to have a base where some of the other crypto assets don't make sense if they're trying to be money. Dogecoin doesn't make any sense. I'm sorry that I don't know why the news media will only give these crazy things. And, you know, crypto assets are just a tool. More damage is done with $100 bills every day. You know, they don't talk about that. And all technologies, all innovations are used by porn, gaming, and illegal all the time. It was the same way with the internet. It started, you know, with gaming and porn and illegal activity. And so that just is a part of innovation. So those are the early years. It's not like that, you know, less than 1% of all transactions have anything to do with that now. In fact, the Colonial Pipeline, they were able to claw back and find half of the ransom because it was using Bitcoin blockchain. So that wouldn't have been able to be possible with, you know, unmarked bills. So it's a better form of money, and we just have to change the story about really what's going on versus you know, the memes and the storytelling.
I love how you speak on themes, investor having themes and picking themes in which they invest in. Can you speak to that a little?
Yeah, I think themes are really important. I like the idea of sound money as an investment theme. So I would be investing in Bitcoin. I like the idea of autonomous protocols and platforms. So there are a bunch of crypto assets you can buy, like, you know, Ethereum and Solana and some other ones that are about autonomous protocols. There's another one that's interesting called governance tokens. These are different types of assets because they're almost analogous to something like stocks or equity. You can think of equity is like the claim or a right to cash flows after a business has paid all its expenses. And that's a right. The governance token has a right to, it's a different right, but it's the right to vote on the maintenance and upgrade of that blockchain. And so you really have power, democratic power, to be able to, you know, scope and see how this is going to be upgraded, what features it has, and then ultimately, if it's generating cash flows, how those cash flows might be disseminated. And so,
can you give an example of a governance token?
Yeah, something like Compound. Compound is it's a platform where you can go and lend and borrow cryptocurrencies. It generates interest rates for borrowers and for lenders. It takes a fee, you know, the software automatically takes a fee for some of that. It also gives out Compound tokens for participants as incentives for using the platform. And so people want more and more Compound tokens because they, you know, then they can, you know, vote on the Compound blockchain. And so with Compound tokens, when they have upgrades or when they decide to add different crypto assets, or you know, sometime in the future, they may vote on, you know, distribution of revenue. And so these governance tokens can be valuable if the community, if you know, all these blockchains are economic communities, right? And if there are incentives in there, and if more and more people are using that, value is getting created. And if the value is getting created, then the right to govern that value is also going up. And so this idea of governance tokens are really valuable.
When you talk
So
about,
those are a few things.
well, thank you. When you think about a few more questions, when you think about volatility, can you speak to the volatility and kind of the trends that have happened, and then kind of contrast it with fiat and our traditional means of what we consider money? Can you talk about people? Well, you think about, I think was it 2020 that a lot of crypto, it was kind of dead or didn't move, or there was a point where, everybody's like, oh, it's done, it's over. And then there was a surge, and then it's up, down, up, down, up, down. But when you talk about that in the long term, and I know it's been a short window, it's not 50 years to be able to evaluate, or even 100 years, but can you speak to what you're seeing with volatility and people's concerns about volatility of cryptocurrencies?
Yeah, it's painful. You have to really ultimately think about this as a technology first, and we're just really in the early phases of it. And so when something is limited supply, and then when it's reflexive, it's very reflexive. And so what that means is when it goes up a lot. And when it goes down a lot. And so, we hope and theorize that as it becomes bigger market cap, multi-trillions of dollars, the volatility will diminish. And ultimately, when it becomes more and more adopted and used, then the volatility will diminish. But the volatility is hard. How you handle that is through duration and through position sizing in your portfolio. So that's why you would put only, say 5% of your portfolio in something like, Bitcoin or crypto assets, or more if you can handle volatility and know that you're going to use duration. Anybody who's had Bitcoin longer than 3.25 years, so 3.25 years, has made money on Bitcoin. So as long as you had held it that long, you didn't lose money. So with volatility, you have to have commitment to duration, to holding it, and having position sizing, having it not too big of a position in your portfolio.
When you when you talk about exchanges, do you purchase and leave your purchases on exchanges, or what is your feeling about wallets? That was a friend that told me to ask you that. They had a list of questions that they said, ask him this, ask him that, ask him what he thinks about the exchanges and the wallets, because he lost a little bit of money in a test. He said that he didn't know what he was doing, and it had him verify here, and then somebody got him for, let's say it was a couple $100, and he said, I wasn't sweating it because I was testing it anyways. But he says, can you ask Mr. Ryan about wallets and the exchanges? What is his feeling on them, and how he personally, what he does and what he would do for your clients as well,
Yeah, so it's a little bit different for me because I'm an institution and I hold it, or I have it custodied by a third party on behalf of my clients. But and I need to do that, for regulation reasons and other reasons. I think eventually in the long run, everybody needs to have wallets and personally own and understand how to use wallets. But that takes knowledge. It takes a while to figure out how to send, Bitcoins around and how to manage a wallet safely. I think it's okay in the beginning to, for a while, to just keep it on exchanges, provided that you have good security precautions. So good security precautions include using two-factor authentication and using whitelists to limit the addresses that your currency can be sent to. So if you have good, strong passwords, if you have two-factor authentication, and if you have whitelists, I think keeping it on this exchange is a valid thing today. Whereas in 2017, it was more risky, I would say. But really, in the future, ultimately, not your coin, not your keys, not your coins. You want to be able to have, these are bearer instruments. These are, the value is within the holding of them. If something goes wrong or goes down, you want to have them in your possession. If they're in an exchange, they're not technically yours, right? And so not your keys, not your coins. Ultimately, you want them in wallets. So
years when I did the set it and forget it with the little bit that I put in, and I had used one Binance in, I think it was 2017. And then, some of my peers who had actually been watching their stuff were like, hey, you can't, Binance got shut down or something. And they said, you got to go and get it off of by this date. And, they said, let me come to your house and I'll put it in a wallet for you. And so they did that with a good portion of it. There's some still there, but I didn't understand it because they said that they were explaining to me about wallets and saying that, you want to make sure to have it in your possession versus the exchange was a good introduction for you, but you need to have it in a wallet. So right. Your feeling is, like you said, if it's not in your possession, then it's not yours. Do you believe there are good ways for people to pick, or do you have a criteria on how people should evaluate wallets and even learn about wallets? Have you found resources and information for people to read up more or study? Because, the learning curve of even picking the right wallet.
Yeah, the general standard is that the hardware wallets are better. So there's a couple makers of hardware wallets. There is a service called Casa that is very reputable. They only handle Bitcoin, but it's a very strong wallet or service of a wallet because it does multi-sig, right? You have to have multiple people sign off. And so that one is a third party, but you do have the wallets. So, a hardware wallet like Ledger or a service like Casa, I think are all pretty good. But it takes a little research and figure out which one works best for you. I think it's okay to keep things on exchanges, but you want the ability to be able to put it on the wallet and know that you have it. Yeah, that's important.
What is your feeling with, you talk about programmable money overarching as what this is. What are your feelings about smart contracts? And can you talk a little bit about some of the opportunities for creatives with intellectual property and kind of monetizing the things that they create on? So for instance, you being an author and you not with something like smart contracts, would you need some of these third parties, or would you be able to just do some of these same peer-to-peer things, direct to consumer, and reap the benefits for the life of a work?
Well, there's all kinds of ways that smart contracts, will be used in business from all kinds of operations, but specifically about content creation, smart contracts coupled with NFTs, this idea of a non-fungible token, these unique.
Can you define what that is, an NFT? There's talk everywhere of people, a baseball card has now been digitized, and it's some artist did some digital. I actually know a kid that made like $75,000, and he was like 15-year-old because he's been doing digital art from NFT. So can you speak to what an NFT is and then speak on smart contracts like that?
So an NFT is a non-fungible token. Money is fungible. A Bitcoin is a Bitcoin is a Bitcoin. But NFTs are unique. They're unique items. And so they're not fungible. And so what's interesting about them is to be able to show ownership or guarantee ownership of an item. It works really well for digital assets because it's easy to use NFTs for the digital world. If you have music, or if you're an artist, what's really great about NFTs, could be something like, right now, if you're an artist and you sell a painting from a gallery, you only get paid once. But if you were able to use NFTs to transform to transfer the ownership of that art, then every time the NFT transferred, you could have smart contracts that say, all right, you know, whatever the cost was, 10% goes back to the original artist, right? And so tons of artists, tons of music producers, you know, anybody who has intellectual property in the future is going to be able to create multiple revenue streams where right now they're only paid once, and you know, people can trade their stuff and they never get to see any benefit of that. So I think there's a lot, and blockchains can be used to eliminate fraud, right?
Yes.
NFTs, you can eliminate fraud because you're guaranteed to know, you know, whoever owns the private keys of that NFT is the owner. And so I think there's a lot that's going to happen over the next decade with content creation and with art and the blockchain.
So when you talked about privacy in the book and kind of the importance of privacy, I think privacy is, I think humans are created in my assessment, and that's part of fundamental, because I hear people say, you know, if you're not doing anything criminal, then what does your privacy matter? And I don't know how I feel about that. I just think fundamentally that's part of being human, is having privacy. It doesn't mean that you are doing something nefarious. It just means that you're not always on. You're not, Jake can go and see his family and his friends and have the dignity of choice to sit with them and have conversations that are for them to hear. I mean, that's just life. So when you talk about using some of these services that are quote unquote free, but it seems that the users may be the product. Can you speak a little bit about privacy and the concerns based on where we're currently at, and then what the blockchain may provide for people?
Things like, you know, Google, Amazon, Facebook. I mean, these serve, you know, a third of the globe, and they can determine
FANG stocks,
and they can determine who gets to use them and not, and they get tons of data on us. We relinquish tons of data. That can get worse and worse and worse as that data gets more and more aggregated. It's not just, you know, then that starts to get, you know, Google and MasterCard created a relationship, and then you're able to aggregate that data and see who, you know, more and more about a person. The scary thing is, as that continues, you know, what if decisions of insurance or something start to get affected because they know so much about you? The other thing is just Big Brother chills the discussion of a person. You just start to be scared to say things, or be scared to express things. I mean, you can even feel it on Twitter. You don't want to say things just because there's this, you know,
you can get canceled.
You get canceled
from a 15, 20-year-old conversation, or just
yeah, I mean, it's unbelievable that, you know, somebody said something 9 years ago and, you know, they're having to apologize for it or whatever. So you don't even want to say anything on it. Or if the government starts to then be able to make decisions based on information that should be private. So we want to be able to have commerce where we get our privacy back. With decentralization, we can be pseudonymous or more anonymous and keep our own data. And we can ultimately then make our own money by selling our data and restricting the access. Yes, you can have some of my data for some amount of time for a price. You'll be able to keep your data and make more on it. And that investment theme is called Web 3.0. There's a whole
they talked about social media like that. They said a new social media where people would control basically the licensing of their data. It's like you use it for this amount of time and then pull it back. And there are people working on this right now.
Yeah, Web 3 is coming. And so it's really interesting. You know, you'll be able to, you know, the Brave browser, you know, there are many tools that are being used that are creating the Web3. So Google Web3, it's very interesting.
Perfect. Well, thank you. That's a good point for us to stop. I appreciate your time. And where can people find out about you? What's next for you in a nutshell? Are you going to tour with the book even digitally? What's going on? How can people find you and find more information about it?
I've been doing a bunch of that. You can find me at Twitter at Tradecraft Jake. You can find the book at ageofautonomy.com. I'm on Twitter, so you can definitely find me there, Tradecraft Jake.
Perfect. Here is the book. You want to get a hold of it. You want to go find Jake on Twitter, and you want to avail yourself of this resource. I think it's a great read, and I recommend it for people if you want to get a better understanding of crypto assets in the age of autonomy. Thank you for your time, Jake. Have a great rest of your day and week.
You too. Thanks so much, Andre. Take care.
Thank you for listening to today's episode. Do us a favor. If this was useful in any way for you, please go to iTunes and leave us a review. Reviews will allow others to easily discover the podcast. If you'd like more information and to receive a free download, Rediscover Your Destiny, go to CIOofdestiny.com. Thanks again, and tune in next time.